Please work through the following 3 definitions as self-study. The reason why I have included them is that you need to remember when there is theory questions, you need to identify that a financial asset or liability should be linked to your conceptual framework. Therefore, when we look at our financial asset, it has to be potentially favorable. What does it mean? Favorable? Our entity has to receive future economic benefits. Then, when we look at our financial liability, it has to be potentially unfavorable to the entity. Therefore, an outflow of future economic benefits. I want to discuss the classification of liabilities versus equities. Remember, I've mentioned that often it is difficult to determine if it is a financial liability or equity instrument from the perspective of the issuer. Now, what is the issues experienced? That there is no contractual obligation to deliver cash or another financial asset. Therefore, guys, it can be difficult to determine that future economic benefit flowing out, the contractual obligation. The second issue is that settlement can occur in the entity's own equity instruments. And then contingent settlement provisions. Now, when we think about contingent settlement provisions, what is this? If you think about IAS 37, you will remember contingent assets and liabilities. Remember, we do not recognize contingent assets and liabilities. Now, what does it mean not to recognize? We do not include a journal. Why not? This is uncertain future events. Therefore, this is events that can happen or cannot happen. It's uncertain. But we have to disclose this in a note for the readers of the financial statements. Number 4, our settlement options. Remember, this is a choice of the issuer or holder to settle this in either shares or fixed value. Now, on our right-hand side, I have included our table with the questions. But we will look at an instrument that is an equity instrument if both of the following are met. Now, when you look at our diagram in our black box, remember question number 1. Is there a contractual obligation? If your answer is no, question number 2. Will the contract be settled in the entity's own equity instruments? Now, previously we have indicated if this is yes, we know that if it's fixed, it's equity. Okay? But now we are going to take this one step further. This will be equity if non-derivative financial instruments that include no contractual obligation for the issuer to deliver a variable number, or if the derivative financial instrument will be settled only by the issuer exchanging a fixed amount of cash or another financial asset for a fixed number of its own equity instruments. Guys, important. When we look at our non-derivative, that includes no contractual obligation to deliver a variable. Therefore, guys, do you see that this still means fixed? That there's no contractual obligation to deliver a variable. And when we look at our derivative, it has to be settled with a fixed number. Okay, so guys, again, when you then look at our black box, our questions are pretty sufficient. The only thing that you have to identify is if it is fixed amount of shares, It's equity. Now, I've included our definitions for explanation purposes. Let's look at this section. The instrument includes no contractual obligation. I want to discuss the critical feature test in terms of our contractual obligation. Sometimes it is very difficult to determine if there is a contractual obligation to deliver cash or another financial asset. We need to look at this from an unconditional right to avoid delivering cash or other financial assets. Now, I have looked at the definition of unconditional, and this is when there is no limits, and I have linked this to an unconditional love. Now guys, just bear with me. Let's think about this one. I know that this is pretty funny to include unconditional love in a financial accounting lecture, but what is an unconditional right? Unconditional love. I will love my little one no matter what. Does the entity have the unconditional right to avoid delivering? No. Then the obligation will meet the definition of a financial liability. Yes, there can be some exceptions to the rule. It is important that you know that we need to look at the substance over legal form. Therefore, our substance will provide us with the guidance of that financial instruments. For example, when we look at preference shares, if the preference share provides for mandatory redemption, now what's the meaning? There is no choice. They have to redeem the shares by the issuer for a fixed amount at a fixed future date. Now, when you look at our black block, if we are talking about question number 2, will the contract be settled in the entity's own equity instruments? Yes. For a fixed amount, then this will be equity. But now I am telling you that you need to look at the critical feature test, number 1. Therefore, you need to look at the unconditional right to avoid delivering. Now, in this preference share, where the issuer has no choice but have to deliver the shares, being fixed amount at a fixed future date, do you agree with me that this will be an obligation to the issuer to deliver substance rather than legal form, and we will recognize a financial liability even if this is fixed amount at a fixed future date? Therefore, guys, it is important that yes, you need to study this black box, how to determine if the instrument is a financial liability or equity. But guys, then you need to think about the critical feature test, and you need to think about our example on preference shares. Now, you can read through this, very similar to our diagram. I'm only briefly going to touch on contingent settlement provisions. This is a financial instrument where there is an uncertain future event that can lead to delivery of cash or another financial asset. And this is beyond the control of both the issuer and holder. We need to look at the unconditional right to avoid delivery. Therefore, if our answer is no, that there is no unconditional right to avoid, what does this mean? The issuer has to deliver. Therefore, the issuer has an obligation and needs to recognize a financial liability. Now, you can work through the rest of this page. It's self-explanatory. Remember, a compound financial instrument is a non-derivative financial instrument. Remember, what is derivative financial instruments? One the value will change due to an underlying. 2, no or a small net initial investment. And 3, settlement will occur at a future date. Now, a non-derivative financial instrument can have both a liability and an equity component. And it is important that when you identify a compound financial instrument, that you work through this in steps. Step 1, you need to calculate the fair value of the instrument at initial recognition. This is transaction date, day 1. Step 2, you need to calculate the present value of the liability component based on market related rates. Step 3, you need to deduct the present value of the liability from the fair value of the instrument. You will have to calculate the fair value, number 1, minus number 2, our present value. This is our step 3, and this will be our equity portion. And transaction costs shall be allocated to the liability and equity in proportion. Treasury shares, I have explained this to you. Other issues, interest, dividends, losses and gains. If this relates to a financial liability, this shall be recognized in profit or loss. Transaction costs of equity transactions will be deducted from equity. Now let's just think about this. Remember, equity will increase on our credit side. Therefore, when transaction costs is paid, we will credit bank and we will debit our equity. Therefore, do you identify that our equity will decrease? This is a deduction from equity.